Today we have the privilege of having Jenny Lian. She's a CPA. She's been in practice for 16 years and works at KRP, which is a boutique full-service firm with close to 50 years of history. Her practice area is assurance and business advisor, including tax advice. They have a 4-person tax department dedicated to tax practice, but the whole firm has about 40 employees. Jenny?
Thank you, Angela, for a kind introduction. And also thank you, Concord Adex and Stephen's team inviting me to be part of the presentation. So today's topic is taxation on residential real property. So from time to time, I run into friends and the clients who will ask me, given the real estate boom, they wanted to invest in the real estate market. And in most of the case, the first question they will ask me is, what's the best ownership structure I should have to own this piece of real property? Does anyone know, for a typical accountant, how she or he will answer the question? Sorry? No, it's just general ownership structure of a real property. Anyone? It depends. That's the quick answer in 5 seconds. You know you run into your accountant when you have questions and you will never get a straight answer. You're gonna go through this long conversation and say, where is this gonna end? You keep asking me questions. I'm asking you questions and you don't give me answer. But to answer the question properly, we do need to know a lot of answers in your head. And also it involves the type of properties you wanted to invest, whether it's residential or it's commercial. It also depends on the funding sources of the investment, and also the ownership intention is also needing to take into consideration. Of course, next thing is, after that, they're gonna say, how much is gonna cost me to pay tax when I have rental income? And what about I have rental losses? And how much expenses I can write off? And the end of the day, and say, if I sold this piece of real estate, how much is gonna cost me for tax? And a lot of scenario is client or friends, they come in and they have all sorts of questions and ask me one single question, which I cannot give the answer. I can only give the 2 words answer. So without overdue, and this is my today's agenda: ownership, structure, which that's my opening, and then discuss the taxation of income, rental income, and discuss the taxation on disposition of real property, and deem the disposition to the extent as an extension of a disposition of real property. But it is own animal on its own, so I wanted to point it out and have it as a separate topic. So, personal versus corporate ownership. There's various elements you have to think about. The commercial and the residential, if it's a commercial piece of a property, we usually will say to client, there's so much risk associated to it, you might want to invest it in a form of corporation. These type of a commercial property, including rental plaza, retail plaza, warehouse, office building, or plant. If it's a residential property, we usually tell the client and say, just keep it simple, own it personally, and which I show you there's, tax implication is sometimes it just outweighed the benefit of owning it through a corporation. The next question that client will ask me is, what about taxation in the rental income during my ownership? What if I have rental losses? I have so much expenses, right? That's where you have rental losses, what I'm gonna do? can I use it immediately? The other question, sometimes the accountant or accountant will bring it to clients' attention is tax write-off. There's a lot of question on the tax write-off, which will have pros and cons implication, which is such as a building amortization. So this is on the taxation part, and aside from the implication on the death and the disposition. The other part you wanted to consider is the cost, the maintenance cost during the ownership property for the compliance purpose. For compliance purpose, if you own it personally, then you only file one personal tax return and including your rental activity and call it a day, pay your tax. But if it's owned by the corporation, not only you're going to file corporate income tax return to reporting the rental activities, you also need to have to engage a lawyer to file the minute book, maintain the minute book of a corporation, as well as the corporate annual filings to update corporate status with the provincial government. So here is the overview, a quick overview of what's the tax implication and the different ownership structure. So if it's net income, rental income, it's taxed at owner's gradual tax rate. For this presentation purpose, in my following slides, my calculation on the tax analysis is based on the tax rate at the top income tax bracket individuals. And right now, if your taxable income is at $220,000 and above, this is the income tax bracket that I am used to do my analysis. For the corporation, the net rental income is taxed at the fixed rate. And I will show you my presentation later on the calculation. Net rental losses, great news. If owned personally, you can write it off. You can apply against your personal income. If you have a salary, you can against that, and you pay less tax. It's immediate tax saving in the year of a filing. But for corporation, if you have rental losses, your rental losses is trapped. However, when I say trapped, that means it can be carried forward or backward for certain years with the legislation allowance that you can use it against the future rental income. Tax amortization, a lot of people will say, oh, I have rental income. I can claim capital CCA, right? If I claim CCA, I'll have rental losses, and then I can use it against my other income, which is not the case. Tax rules specifically prohibit that calculation to be integrated into and allow you to claim the CCA more to create rental loss at the personal level. But for corporate, you can claim the allowable CCA to even result in a rental loss because the rental loss is trapped in the corporation. You can carry those losses, carry over to future years against the rental income. So as you can see, different ownership will result in different tax implication. Oh, I think that's sorry. I changed the presentation. So here is the consideration summary. So for your benefit, you can look at it. From the rental, I summarized it. There's also exposure about lawsuit on property that's a legal subject. For the corporation, I would like to give you some overview on the tax rate. Rental income is at the corporate level is firstly taxed at the 50.17%, and which included that in that tax rate, 30.67% is refundable upon payment of sufficient dividends to individual shareholders. And losses can be only used to shelter income earned by corporation. and there's limited risk because corporation is limited liability. And given the current tax rates, there's a potential tax cost if owned through a corporation. I can show you why, which I have to go back to. So one concept I wanted to introduce before I dive into the analysis is the tax integration. So the Canadian taxation system, the tax bracket that you see at the personal level, is taking into consideration of called tax integration concept. So the tax integration is such that it's designed to ideally that tax cost of income should be no different on a flow-through basis. This means regardless source of income, either corporately owned, earned, or personally earned, the tax cost should be the same upon ultimate distribution to individuals. So if you look at the active business income, if $100,000 of income earned by a corporation, the corporate tax rate is 12.5%, federal and the provincial together, which is under small business rate. And the personal tax on the dividend, which is the $87,500, is $41,475. The cash left in the taxpayer's pocket is $46,025. If it's that $100,000 earned individually, the top income tax bracket rate is 53.53% for 2019, and which left in the taxpayer's hand is $46,470. So the tax cost, if you're using corporate vehicle to earn active business income, not rental income, is $445. There's some deficiency there, but it's almost integrated. The differences is negligible. If it's rental income, $100,000 of net rental income, first to pay corporate tax at the $50,167, and upon paying the dividends, you will get a tax refund. Remember I said there's 50.17% of overall corporate tax rate. The 30% and change is refundable upon distribution of the dividends. So that left with the corporation $80,500 that can be distributed to the individual shareholder. And that individual shareholder, if his other income is over $220,000, that dividends will be taxed at the 47.4%, which will left in the shareholder's hand $42,342. And if that $100,000 of rental income earned personally, the tax payment, the after-tax payment, the cash left in the pocket is $46,470. So just trying, I don't think this one, if you can see it, the tax cost, if using corporate vehicle, it's $4,000, it costs you more. For $100,000 of rental income, it will cost you $4,000 more of taxes, given the 2019 tax rates. And this cost will be even higher in 2020 because provincial government just raised the tax rate on non-dividends on that type of a dividends income another percentage point, which will be 47.74% on that 80,500. So the gap, this amount will be higher because of the increase in the tax rate. So as you can see, it's not perfectly integrated. Actually, in this rental income scenario, the taxes are going to cost you more for owning rental property, residential rental property in a corporation. The main reason of this tax deficiency is because in 2018, Justin Trudeau announced the decrease of small business tax rate, corporate tax rate, from 10.5% to 9%. This decrease has to be factored in when those after-tax income gets distributed to individual. In order to achieve the tax integration concept, federal government secretly increased the corresponding non-eligible dividend tax rate. So think about it. It's a one set of a tax rate. The end of the day, if you have to pay 50% of a tax on $100 income, it breaks into two pieces. If it's a small business income, its source of income is small business, you will tax at a lower rate, right? And then you get a tax out at the 50%. But in the investment tax, corporate income tax rate, it doesn't change. They are taxed at the same rate when it arrives in your personal hand. So that's why in 2019, you are looking at the 4.1% of tax leakage, that's what we call it. So that's very important elements for your decision making, because why do I need to pay that much of the tax when I can retain $46,000 versus $41,000 of cash in my pocket? I don't want to make that contribution. Not to mention that you have to pay accountant and lawyer to file corporate income tax return. Those elements haven't taken into consideration in my calculation. So besides that, I'm going to talk about other things surrounding the corporate ownership versus individuals. But first of all, I think a lot of people will ask, how am I going to calculate my rental income? The rental income, this is taking from personal income tax return schedule, which the calculation is no difference, or eligible elements of expenses is no different between corporate filing versus individual filing. But few things, like a lot of common expenses, I don't want to go through it because it's very self-explanatory. There are two things I highlighted in the arrow: travel expenses and the motor vehicle expenses. They are in the same elements of a commute incurred for business purpose. I have a client who has property in Turks and Caicos, rental property. He owns several units, and 3 units rented out, 1 unit owned personally. I'm not trying to advise you something differently or trying to hint you on certain things. So every year he has to fly down to Turks and Caicos. He has to take care of the rental property because of hurricanes causing the damage. He has to do renovation. He has to deal with the contractor. He has to deal with the tenants, various issues. His flight cost, with a reasonable support, it can be deducted, right? He can stay his own unit and taking care of the tenant demands. It's deductible. Motor vehicle expenses, similar concept. If you don't have a flight, you go to other places. What if your property is in Barrie and you have to drive to that place to taking care of tenants' requests? What about repair and maintenance, or collect the rent, or getting a new tenant in, talking to your real estate agent? Those motor vehicle expenses, related expenses, can also be deducted. So I found a lot of people just focusing on my advertising or repair and maintenance, and the travel and the motor vehicle is something that you wanted to take into consideration, those type of category of expenses. It's true expenses as long as you can if you do have a scenario that you can substantiate your claim. So if you jointly own property with your partner or someone as a friend, so usually you will come up with a full calculation of the property rental income total expenses that jointly claim. Then you comes down to other deductible expenses that you did not put through the property on the property books, but it's a legitimate expense, and you just agree with your partner that I'm not going to put through the claim to the property. I'm just put against on my side when we claim when I report my rental activities. And the next item is basically capital cost allowance. Capital cost allowance, there's a pros and a cons. If you claim it, if you have rental income at this line, if you have rental income at this line, and you can consider, you wanted to take into consideration, say, I want to claim CCA. This is the place you claim it, so you can, if the CCA allowable amount is higher than your rental income, you can bring down your rental income to 0. So they are no different. These type of, besides, except for CCA, there's no difference in terms of calculation, either the rental property owned personally or corporately. One particular subject on the CCA, I don't want to go through it because it's very technical. One thing I wanted to point it out, which will benefit our future presentation, is when you buy a condo unit, you have two components, land and a building. So you can only claim amortization tax write-off against the building, but not land. And in the condo scenario, the land component is usually typically take 10% of the total proceeds as your land, and 90% is your building cost. Disposition of real property. So if you're investor, you're investing rental property and that's not your major business, the real property is considered to be in account of a capital, and it's not land inventory. In real estate agent scenario, there's, if you have multiple units and you constantly rent out and you constantly flipping, then it could be in CRA's eye, it's on account of a business income, then the taxation scenario will be totally different. But today, for today's purpose, my focus will be on when the real estate is on account of a capital. So when you dispose a real property, you purchase, for example, $100,000, which maybe I should add 0, not leave it as 6 digits, for simplicity. 70,000, okay, again. Nope. Yeah, that's here. Okay, good. Thank you. So $100,000 of a property cost splitting into two components. 30,000 allocated to land, 70,000 is to building. So throughout the ownership period, you claimed $30,000 of amortization on the building. Property sold for $200,000, and 140 of the sales proceeds allocated to proportionately to building, and the 60 allocated to land. And the tax on sale of land is about, given the current income tax rate, so $60,000 of proceeds cost is 30, capital gain is 30, and 50% is taxable at the current tax regime. But just so you know, there's a big talk in the industry that capital gain inclusion rate will increase from 50% to 75%, likely to be introduced in the next federal budget. It's significant, I know. The tax on the $15,000 of taxable capital gain is $8,030. And the sale of a building, $140,000 of proceeds lead into capital gain $70,000, and half is taxable, so $18,730. Remember, you have that $30,000 tax write-off throughout the ownership period, during the ownership period, and the tax on that is business income. It's not capital gain rate. So it's taxed straight on the $30,000. It's not 50% of it, it's 100%. And the tax is $16,059. Just so you know, the increase in the dividend tax rate has no impact in this scenario. Terminal losses. I think this is a joke, right? Who's going to invest into real estate market and given these days of a market will incur terminal loss? But I just leave that slides there to, for completeness of in a presentation. But one thing you might want to know is sometimes you allocate your 100% proceeds, 70%, 30% between land and building. You might want to keep that rate when you sold the property and realize the proceeds, because the allocation consistency is where CRA wanted to make sure that to adhere to, so that you're not taking advantage and say, what if I think the land is worth more than the building, so I'm just going to claim, I'm just going to allocate 70% of proceeds to the land, or 30% of proceeds to the building, and I only pay tax on the building, on the capital gain, which is 50% taxable. So CRA has a mechanism to stop that. Okay, so there are few interesting subjects that I wanted to discuss today, other than the income on regular income. For example, if it's a tax planning point that I wanted to discuss. So for example, you sold a rental a real property, whether it's rental or personal. It's personal rental, extra cottage that's also subject to tax if you don't designate it to as a principal residence. So if you sell that property and take a vendor take-back mortgage, so when you sell it and collect the full proceeds, there's no tax planning opportunity. But if you sell the property and say, okay, I can't do a vendor take back, I only collect half of the proceeds, and in that proceeds in that 1 year, and the second year you pay me the other half. The capital gain on that tax, on the sale, is only 50% is taxable. I can show you later on the illustration. And the other thing is, there's called the replacement property concept, which I will also briefly touch on it. So capital gain reserve. So taxpayer sells property for $500,000. Cost of a property is $400,000. The taxpayer receives only 50% of the 500, which is $250, at the date of sale, and receives a 1-year vendor take-back mortgage, so that the other half, the second half of sales proceeds won't be collected until the second year. That's the capital gain on the property, $100,000. So the calculation is, in the year 1, your revised capital gain is not 100, it's $50,000, which is half of the entire capital gain. And then the taxable portion is $25,000. So if your income tax bracket is not at the top income tax bracket, if you are at the 46%, not 43.53%, and if you collect the full proceeds, which will cost you more to pay tax. So basically, you are doing the tax deferral and the tax saving, permanent tax saving, by spreading the proceeds over at the maximum 5-year period, which is allowed by the CRA. However, we always say that you cannot let the tax tail wag the dog, which means tax is not the ultimate driven decision-making elements. You have to take various things into consideration. For example, vendor take back. What if the buyer default on the payment and the market goes sudden downturn? You can't even realize that. There's always elements of risks involved in this type of design. But if executed properly, it should realize a overall tax saving, permanent tax saving. So it's still the old one of the problem. Let me talk about the replacement property. I also run into a client say, I just sold this property and I wanted to use that proceeds to buy next one. Someone told me that I don't have to pay tax on the gain I realized in the property sold. It is true if it's a business property. Let me give you a scenario. This is my client case. My client owns a commercial business property that he used for his own business purpose. So throughout the ownership period, he collects rent and from the business because he owned it personally. Then the business grows. The property itself is too small to house the business. He then bought another one, bigger unit, but he has to sell the current one. So what end up with is the property, because it's family owned, been many years, there's a huge capital gain in there. There's also recapture, which is CCA claimed in the past. Because he invested the entire proceeds from the property to the next property, which is going to house his business, the entire capital gain and the income, taxable income on that transaction is deferred. He's not paying any single penny of taxes in the year of disposition, nor in the next 5 years. Because the concept of CRA, the tax design is such that they encourage business owner to reinvest into business. That's how you can stimulate the economy. So the replacement property concept can only be used for business reason. For business property, when you own it and you run the business within. It's different from if you are a real estate company, owns that property, rent it to a business which is not relating to yourself or your corporation, then that cannot be used because it's not for your own business use. So now we are facing, what if the client suddenly passed away? The concept of deemed disposition upon death, I think most of you guys, everybody knows, it's a common concept now. So upon death, a Canadian taxpayer is deemed to dispose of his or her real property holding for proceeds of disposition equal to the fair market value of the property at the time of a death. And it could result in capital gain or income gain and recapture on the property, whether it's personal or corporation. And I will talk about corporation later. The other thing you wanted to know is if the surviving spouse, if you have a surviving spouse, then it can be rolled over to the surviving spouse at the cost, so there's no immediate tax implication. In a lot of scenarios, I run into clients who are assets rich and cash poor because the ownership of real estate property is for 20, 30 years. When market goes crazy, your capital gain is also a astronomical amount. And when you do not have a sufficient cash to pay tax on it on the deemed disposition, and you cannot do a rollover to your spouse upon the death, then your estate will have to pay large tax to the CRA. And in a lot of scenario that you are forced, your trustee of your estate will be forced to liquidate the property in order to come up with the tax to pay. So in that scenario, we constantly advise client about utilizing a insurance policy to cover that type of tax liability in the future. I think overall it's a primary, it's a very well used, and I believe John Michael, which is the next presenter, will cover that subject.